Hi friends, welcome to my accounting class. Today we are going to discuss about the basic accounting principles. So this accounting principles helps you in learning the basic accounting practices and preparing of financial statements, as it provides you the basic guidelines regarding the accounting skills also, to develop the basic accounting knowledge, to prepare and practice accounting statements. You need certain basic guidelines, general guidelines. Those general guidelines are called basic accounting principles. Okay, so these accounting principles are not only give you the general guideline, it also gives you the basic knowledge, the basic skills in preparing and maintaining the accuracy of financial statements. That means to fulfill the basic accounting informations, the four basic qualitative characteristics of accounting information, like reliability, relevance, understanding and comparability. To fulfill of those four basic qualitative characteristics of accounting information, you need the basic accounting principles, the basic accounting assumption, concept and the principles which helps you in preparing the accuracy in preparing and presenting the accuracy in financial statements. So let's come to discuss. So this basic accounting principles are come under generally accepted accounting principles. Generally accepted accounting principles, shortly it is called GAAP. And this generally accepted accounting principles, GAAP, is given by American Institute of Certified Public Accounts and the Institute of Chartered Accountants of India. In India, this Institute of Chartered Accountants of India also accepted this generally accepted accounting principles as the general guidelines, the basic principles, basic knowledge for preparing and maintaining the financial statements. Okay, so this generally accepted accounting principles, so that GAAP has been classified into three basic principles. The first basic principle is called basic accounting assumptions. Then second one is called, this is first basic accounting assumptions. Second one is your accounting concepts. And third one is your modifying principles. Now let's come to discuss the first one, that is the basic accounting assumptions. Why we need basic accounting assumptions? Basic accounting assumptions are the conditions or the assumptions which we are assuming before preparing the financial statements, or before preparing the accounting statements. Okay, so that these are called the basic assumptions, the basic guidelines, which gives you the fundamental knowledge regarding preparing of your financial statements, presenting of your financial statement in a very systematic manner. The first basic accounting assumption is accounting entity assumptions. What is that accounting entity assumptions? Accounting entity assumptions says that entity means that is the artificial persons created under the law. So accounting entity means accounting is to be treated as that business entity is an artificial person created under law, and it is separate, that accounting entity is to be created for the business or only, which is artificial persons, and it is separate from the natural persons like owners and others. So that means there should be a differentiate between the owners and the business. That accounting entity assumption is also known as the business entity assumptions. So business entity assumption, accounting entity assumption is same, because business is a separate entity, accounting is also prepared for the separate entity. That means owners and the business will be treated as separate entity, separate persons. The business transactions and the owner's personal transactions should not be mixed together, so that the accounting will be jumbled and it does not reflect the correct, the accurate pictures of the records or the statements or the results. So if you mix both the owners and the business transaction, then it will be confused. So owners transaction will be separate and business transaction is to be separate. For example, when owners invest money in the business, that is called capital. Like when owners withdraw the money from the business, the concept is called drawings. So this is as per the accounting entity assumptions. Then the second assumption we call it is a money measurement assumptions. That means this is second important assumptions, the conditions which we have laid down before preparing the financial statements. So since we are preparing accounting in India, we should adopt the money measurement assumptions, means all the transactions should be measured in terms of monetary unit, the money value. All the transactions should be expressed in money value, money, that means rupees and paisa, not in other form of currencies or other forms of denominations. So if it is adopt the other forms of currencies with the money, rupees and paisa, then there is a confusion. So it is create the difficulty in preparing the uniformity in the statements. So it does not reflect the correct pictures regarding your transactions. So all the transactions should be expressed in money value and will be recorded in the monetary unit only. If it is recorded in India, if you are recording in America, then it should be followed in dollars only. If it is in England, then it should be recorded in pounds. So in Japan, if it is recorded, then it should be recorded in Japanese yen, so that the people will understand the accounting statements and the records. Then the third assumption is accounting period assumptions. That means for how many days, how many months, how many years, or how many weeks will record the accounting statements or the accounting transactions, so that we will calculate the profit or loss of the business for the operations. So there is also certain accounting period concept assumption is to be followed. Accounting period means always there is the 12 months or 1 year. It should be followed. That is the accounting period. So accounting periods takes into assumptions that always the transactions should be recorded for the one particular year. It should not be more than 1 year, it should not be less than 1 year, because the 12 months yearly transactions is to be calculated and the profits or the loss or the results is to be shown. So that is the fundamental assumptions to be adopted by the accounting general accepted accounting principles under the basic accounting assumptions to take the accounting period assumptions. And accounting period is also known as the government year or the financial year. That means the year, financial year or the government year or the accounting year begins from 1st April to 31st March of the next year. Or the business may adopt the calendar year for the recording of transactions and calculating the results, that is from 1st January to 31st December. So that is a 12 months transactions. Or the government may adopt the financial year, business may adopt the financial year or the government year, or the taxation year or the accounting year, that is generally they are following, all the business are following, that is from 1st April to 31st March next year. So that is the year in which the transaction is to be, the records of the transaction are to be collected and assembled and calculate, prepare to present the financial statements for the particular year. So that is the accounting year. It should not be less than 1 year. If it is less than, then the balance transaction is to be added. If it is more than 1 year, then the extra transactions to be excluded. So that is the accounting period transaction. So based upon this outstanding, that means if it is less than 12 months, that is the outstanding transaction is to be added. If it is more than 12 months, that means prepaid or advance transaction is calculated and excluded. So this the third assumption is to be taken. Then the fourth is your going concern assumption. Going concern assumption says that all the transactions should run for a indefinite periods. Indefinite period, indefinite time. It should be, all the business should run for the indefinite time. There is no ends for the particular periods. The business which today started and will be closed after 6 months. Then it will not fruitful of your application of the accounting assumption. That is the going concern. Going concern means going on, running, continuing for a number of years till the business is running. Your accounting is to be applied successfully. So that is the going concern assumptions. So these are the 4 basic assumptions which provide you the basic conditions regarding the preparing and presenting financial statements. Then come to the second principle, that is the GAAP principles, that is called accounting concepts. Accounting concepts are the what that is called postulates or the theories which we are basic theories, basic principles which are applied for the general preparing the financial statements in a systematic manner. So this is the accounting concepts. So this provides you the general idea. This gives you general conditions, and assumption gives you general conditions laid down, and the concepts gives you general idea, the basic idea, basic knowledge regarding the accounting skills for the preparing of and presenting the financial statements. The first is that is the dual aspect concept. Dual aspect concept means that is the 2 aspects should be followed always. Dual aspect. That means whenever we are going to record the transactions, the account follows the 2 aspects of the transaction. That is debit aspect and credit aspect. There is the 2 aspects. That is called dual aspect concepts. That means all the transactions involve these 2 aspects, debit aspect and credit aspect. Not more than that, not less than that. If it is less than that, then it is a single aspect transactions cannot be reflected in the accounting records. Then second, there is the basic idea it gives you for recording of the presenting the financial statement, that is revenue recognition concepts. Revenue recognition concept means there is the transactions at which point you will recognize that this is my revenue, this is my income. So this is the revenue recognition concepts. So revenue recognition concepts says you there are 3 things. One is there is the cash basis, second is your credit basis, and the third one is your transfer basis. So these are the 3 conditions on which the revenue is to be recognized for the business transactions. That means business will identify the revenue at the 3 points. That means first one is when the business realize the cash by selling the goods or by exchange of the goods or the transfer of the goods. Second is when the business transfer the goods may not receive the cash, that means credit basis. And fourth is when the business transfer the ownership or title of the goods to the from the seller to the buyer's transfers, then at this point the revenue is to be recognized. So this is the three bases on which the business recognize the revenues. Then the third concept is historical cost concept. Historical cost concept means the concept which tells you the recording of all the transactions on the basis of purchase price. That purchase price is to be considered. That means the transaction which we are going to be record, always the transaction is to be recorded at the price at which it is acquired or it is purchased, or the price at which it is to be paid. So the price is to be recorded in the business or in the accounting records. That means current market price is not to be recorded, or the future price, also expected price is also not to be recorded. That means the actual price at which the transaction is to be acquired, the transaction is to be purchased, that price is to be recorded in the business transactions. That means this price will be helpful for simplifying the accounting records, that means statements, the positions. For example, that business purchased a building for rupees 50 lakhs 5 years before. That business will record, as per this concept, business will record the building at rupees 50 lakhs at which the price is to be paid or the building is purchased, not at the current market price, not at the present valuation price. Okay. Next, fourth is your matching concepts. Matching concepts means you will match that revenue and expenses is to be matched so that it will give you the profit or loss. So that is the matching principles. R stands for revenue, E stands for expenses, and is equals to profit or loss. That means the business will match the total revenues with the total expenses of the same accounting periods, because period assumption we had already taken. That 12 months revenue, 12 months expenses is to be matched together so that to identify the results. So that is called matching principles. Previous year revenue, previous year expenses will not be considered. Future year expenses, future year revenues, that means the advance revenue, advance expenses which are to be expected to be realized is not to be taken into account. So if you will take the previous year or the expected the future year, then the results will not reflect the accurate results. To provide the accurate results, we have to match the total revenues with the total expenses of the same accounting year for which it is to be recorded or it is to be accounted. So this is matching principles. Then next is your full disclosure principles. Full disclosure principles means, disclosure means shown to the outsiders. Full means everything. That means everything should be shown to the public or to the parties, those who are interested about the accounting informations. So this principles guides the business to provide all the necessary informations to the publics or the different users. Provide users informations which are necessary. It does not mean that everything will be disclosed. Transparency will be there. If there is no transparency, then if you maintain everything secret, then the public will not believe. There is no reliability of your accounting records upon the accounting transactions. Nobody will understand your transactions easily. So to have the proper better understanding, clear idea, so that there will be no confusion. So all the transactions which are to be recorded should be disclosed to the different users of informations. Whatever they demand, accordingly the accounting should provide the information so that they will be satisfied with your accounting records. Okay. This is called full disclosure. It does not mean that all the transactions, everything will be disclosed by the business. The transactions which are necessary, which are not necessary, like the information which you want to secret, those things should be kept secret, like the technology used by the business, or the formula, the know-how, or the competitors, that levels, how the competitors you will strategies, the plans, policies. This should not be should be disclosed. Only the accounting records, accounting information which are necessary for them will be disclosed for their users, And the last concept is objectivity concept. Objectivity concept means that is the evidence proof. Evidence proof transactions. So that is called objectivity. That means all the transactions should be provided with the evidence proof. Means all the transactions which are to be recorded, that should be objectivity in nature. That means verifiable objectivity in nature. It should be verifiable. Whenever you demand that evidence, means proof of that transaction should be provided, so that everybody will believe, everybody will be reliable, everybody will be understanding your transaction and can be comparable with your records. So this is objectivity, means subjectivity transactions should not be recorded. Subjectivity should be avoided, because objectivity transaction will provide bias free. It is not bias transactions, it is bias free transactions. That means that there is no confusions, there is no different opinions will be arises. That opinions or that records will be maintained very systematically with the proper records of evidence. That means, for example, that payment of salaries to the employees 5,000 rupees. This 5,000 should be recorded with the proof of evidence. Or if it is we are purchased some gross money, that is the stationaries from the market, postage stamps, etc. The bills should be attached with that, so that there will be a objectivity of that transactions is to be provided. If subjectivity is there, that I had traveled from my home to the railway station and paid taxi bills of rupees 500, but no bills is attached, then certainly it is it is not an objectivity transaction, it is a subjectivity transaction. Subjectivity transaction should be avoided to avoid the confusions and the biasness of the transactions. So that is the objectivity should be followed. So these are the basic accounting concepts which provides you the general guidelines in preparing and presenting your financial statements in a very systematic manner. Then again, the third part of the principles are called modifying principles. These principles are modifiable, adjustable, that from time to time, situation to situations. These are constant, this cannot be changeable. Basic accounting assumptions and basic accounting concepts are to be strictly followed with the modifying of those modifying principles. These modifying principles are called the general principles which are to be adapted to the situation to situations. The first principle is that cost benefit principles. Cost benefit principles means the cost, how much cost you had incurred and how much benefit you had realized. So that principle should be followed. If the cost is more than your benefit, then that transaction should not be done and should not be recorded in your accounting books or the accounting records. So that benefit should be more than your cost income or the cost spent for that particular transactions. That means what is your cost and what is your benefit. Benefit means revenue or the income. The cost and the revenue should be always compared while we are going to do some basic accounting transactions, means business transactions. So this principle is to be followed to maintain the systematic records. Then materiality. Materiality principle says that transactions which are more significant in affecting your business decisions, those transactions should be recorded in your accounting records. That means which are significant. Only the significant transactions which affect your business transactions are to be recorded. This is called materiality transactions. It may be 100 rupees, it may be 1000 rupees, but provided there should be having certain significant upon your records. If this transaction is not recorded, then certainly your profits or the losses will be different. So that is called significant transactions. For example, a business does not record of 1 rupee transactions. If it does not record 1 rupee transactions which are made in the business, that means cost is 1 rupee, the benefit is less than 1 rupee. This 1 rupee transaction is not materiality for the business. If 1 rupee transaction is to be excluded, then certainly it has no impact, no significant upon the changes of your decisions, effect of your decisions, impact of your business decisions, effect upon your the calculation of the accounting results. So that accounting results will be not different much more if this transaction is to be excluded. So that because it is a insignificant transactions, only the significant materiality having material values, those transactions are to be recorded in the books of accounts. Then next is your consistency. There is another modifying principles. Consistency. Consistency means there is the constant from year to year. It should be constant. Any things we have, any methods, any principles or any procedures we are following in the accounting records, that always that consistency principle should be followed. Consistency implies that the transaction should be constant from year to year, so that it is easy to comparability as well as the understandability. That means the frequent changes should not be followed. Frequent changes should be avoided, so that business will record only those transactions which are consistency in nature. For example, the methods of depreciation. So when the business records the methods of depreciation, either straight line method or written down value method, that any of the method you are following, that method should be followed from year 1 year to another year, so that the business records will be easily comparable, should be easily understandable. If you changes the methods of depreciation this year, this current year it is a written down value method, next year you have changes again to straight line method, then certainly the results will be different. So it does not show you the correct or the accurate results. So you have to maintain consistency in your records of your transactions, showing of your results, better results. Then next is the prudence or the conservatism principles. Prudence means the cleveritism. The clever, the business always the clever rules apply. The business always follows the rules which will be better for the business transactions, the business results. If the business will not follow for the transactions which will not better for the business transaction, means conservatism means very traditional patterns. That means traditional orthodox system of transactions you are following. That means expect losses not profits. So this is the meaning of these prudence principles or the conservatism principles. That means this principle says that you can expect the losses, don't expect the profits. Why? Because if you expect the profits and if you record it, then you have to pay the taxes to the government, a dividend, mortgages, everything you have to pay more, and it is the loss for the business, though you are not actually realized those profits. But if you expect the losses, then certainly it will reduce your results and nobody will expect anything from the business records or the accounting results. So this accounting results will show the expected losses, don't expect the profits. So this is the prudence or the conservatism principles. So these are 4 modifying principles. These are 6 basic concepts. These are the 4 basic accounting assumptions. So these are called generally accepted accounting principles, which helps the preparing and presenting the financial statements in a very systematic manner. Hope this class you will enjoy it and benefit for the studies. So thank you.